Reconvene this round table, and I thank your all forbearance as we try to stay on schedule here. And I also want to thank yet another New Yorker to join us in the room today. Congressman Peter King is a member of our committee, and Peter, thank you for being with us. I'll yield to you if you have a comment.
Right now.
Excellent. Okay, good.
Thank you.
Thank you. So panel 2 is creating a level playing field for equity market participants is the charge to the panel. Now this panel is slightly different from the first panel. First panel we had was a smaller panel. We had allowed a few minutes for each participant to initially go around with their opening comments. I believe this panel understands going around this time. We're going to, since we have a few more members here, we're not going to do that. We're just going to open things up. This panel will focus, as the first panel, as you all know, looked at some of the history, how we got here, from the regulatory and statutory point of view. This panel, however, will now focus on a macro regulatory issues that govern equity market participants and potential competitive imbalances created by the existing market structure. We have a number of people here, and I guess going around the room. Co-Chief Executive Officer from Headlands Technology, Matthew Andresen. Next is Head of Global Program Trading and Market Structure, Fidelity, William Baxter. From International Securities Exchange, President and Chief Executive Officer, Garrett Katz. And next to him, New York Stock Exchange, Euronext Chief Operating Officer, Lawrence Leibowitz. And then on the other side of the panel, from UBS Americas, Managing Director, Retail Marketing Making, Thomas Matchett. From Head of U.S. Execution and Trading from Credit Suisse, Managing Director, Dan Mathisson. From GETCO, Global Head of Regulatory Affairs, Elizabeth King. And from Bloomberg Tradebook, Chief Strategy Officer, Gary Stone. Welcome. Welcome to the entire panel. So knowing what the focus is in the next hour of discussion, before we hear the opinions of the participants on the merits of the various market participants and the competitive advantages or imbalances thereof and the differences therein, I thought we can start things out, make things a little easy. First have someone take a crack at defining some of those different types of entities that we will be discussing for the next period. And so I go to Headland Technologies. And Mr. Andresen, since you in fact ran a exchange and an ATS and a wholesale internalizer, thought you might be a good one to just sort of lay it out for us what these all are and what they all mean.
Thank you, Mr. Chairman. Well, if I can be accused of talking my own book, I have so many books here, I could probably be a Kindle at this point.
There you go.
So I'll leave it to you to figure out where my views lie at this point. I think it is important to take a step back before we get into the minutia of where we are today in a very complex market structure. And think first about a definition of terms. We have different types of entities represented around the table here today. I think it's worth just taking a moment to explain in broad terms what those are. The first is exchange, like Larry runs, which is a self-regulatory entity. Its job is to match buyers and sellers, but it does so only on an agency basis. They never commit their own capital to trade for profit. Their job is to passively match buyers and sellers. Now, being exchange has certain advantages and certain drawbacks. Advantages are immunity broadly from the ramifications of technology problems they may have, but they also have a lot of challenges. When they want to change or update a rule, they have to ask for permission and have the public potentially comment and discuss what they want to do. So it can be a real competitive disadvantage at the same time. The exchanges also cannot differentiate between their clients. Imagine an airline with one class of service, regardless of how often people travel. that can be a challenge in attracting the best kind of flyers. It's the same problem for the exchanges. The alternative trading systems were created to try to compete with the exchanges. Now, they have advantages that are the opposite of the exchanges. They have a much greater economy of motion when it comes to coming up with new innovations and new market structures. And I think by and large, that can be a real positive. They can change their rules and they can differentiate between their clients. The downside of this is that they operate essentially as like a quasi-broker-dealer entity and have much less ability to, they have extra costs associated with that and extra limitations on liability. The ATSs really came about, as we heard on the first panel, as a result of new technology. In the olden days, we had only floor-driven markets that handled most of the volume. As things moved to electronic, all of these Reg NMS, Reg ATS, all of the acronyms you guys have suffered through and will suffer through for the rest of the day, were really an attempt to take electronic markets and fit them into a world with floor-driven markets and find a way to balance those two things. It was a very difficult task the SEC had, and we ended up, as you'd expect, with a very complex market structure to try to make them go together. The last thing we have are internalizers. Mr. Matchett, UBS, and other markets, they exist to try to commit their own capital to facilitate execution. So they are members of the exchanges, members of the ATSs, and sometimes start their own ATSs. Now, if you can keep all of that straight, we'll be in good shape, but the resultant market structure, as you see these different groups try to coexist and compete with each other, has gotten quite complex.
Matt, you've teed up right out of the gates the big issue, which is competing entities who are doing functionally the same thing with different titles and different regulatory constraints. And I think on the first panel, you probably heard us talk a little bit about investor confidence. And I do wonder if one of the issues affecting investor confidence is the inability to decipher which of you is doing what, when, and where, and which is better. And so you've listed a few of the benefits and burdens of being an exchange. I think there's more. I know Mr. Mathisson over there has a list of the benefits, and I know Mr. Leibowitz probably has a big long list of the burdens. I think for the commission, it's important to make a decision at some point. Are we okay with this? Is this a good construct in which competition is flourishing, and at the end of the day, we can somehow discern that there should be investor confidence because the investor's getting a fair and price that reflects the fundamentals or not. And so I guess I'll open up to you, Dan, to get your thoughts on whether the current construct is fine or whether the commission should be seeking more of a one-size-fits-all title and a set of benefits and burdens.
Overall, thank you. Thank you, Commissioner Gallagher, for the question. And thank you, Chairman Garrett, for holding these hearings and inviting me. Overall, I would say that the U.S. markets are the best in the world. And no matter how you look at the data, whether you look at spreads, whether you look at liquidity, you can look at a large variety of empirical data. It shows over and over again that the U.S. markets are the most liquid in the world. The U.S. has something like half the world's market cap, and 2/3 of the world's volume trades in the United States. So we have, the markets do work. Professor Angel earlier said that nobody's arguing that that on large cap stocks the markets are effective, and I would agree with his assessment. That the markets overall are effective the way they are today. The one way that they can arguably be improved is that there is a lot of operational risk, and we saw a couple of big media type event operational failures in the past year and a half, where we saw the Facebook IPO, the BATS IPO, the Knight situation, like all these situations that came up and were newsworthy events, which then leave an impression in investors' minds that the system is fragile. And I think you could argue that the operational problems that we've experienced are due to the fact that the markets are extremely complex. We do have this very complex market structure with all these different competing entities, and they are stitched together electronically, and it involves a lot of technology to keep it all running and technology can fail. Typically, you see technology failures when you have a new software rollout. And the current system, there are a lot of software rollouts because there are a lot of price changes and a lot of changes to the order types on the exchanges. There are a lot of different changes to routers as people try to figure out how to route the orders best. And software rollouts lead to technology failures. Other than technology failures, which is something that I think the Commission has been addressing, I don't see any significant problems with the market.
And nobody chimes in on that one, so good. Okay, so I think we can wrap this up right now. That everybody's in agreement. Mr. Leibowitz, you?
Sure.
Okay.
And thanks again for inviting all of us. I think this is a great dialogue to start. I wanted to comment, Representative Maloney, I will try to be a ray of sunshine as a representative of an exchange, particularly New York-based. Yeah, I think that a lot of the problems that we have seen are the even whether they're large with a spotlight on them or smaller everyday nuisances that you hear investors and the buy side talk about in the media probably overcover, are the result of natural competition in response to regulation. And I think that while a lot of amazing good things have happened, whether it's decreases of commissions, lowering spreads, it's clear that first a lot of those benefits have sort of dissipated and the marginal benefit it's not improving, that we are all stuck in an overly complex world where there's extra burden of excess infrastructure that we all have to maintain to try to keep this giant Rube Goldberg machine going. And that could be simplified. And that there are areas of concern, particularly in small and mid-cap stocks, where it's not clear that the existing regulatory set works well. I think competition has adapted really well in particular areas. Brokers have gotten better at segmenting customer flow. Exchanges have gotten better at trying to service their customers in certain ways. We have to take the step back and say, okay, we made a lot of changes and we got a lot right. Are there ways where we see down the road that this is evolving in the wrong way? And I think that we are concerned that the lack of incentive to display liquidity in the long run will be challenging, and you're already seeing it happening in the small and mid-cap stocks.
And let me add to that from a perspective of an exchange that's in the listed options market, where we have, I think, a little bit more of a level playing field than exists in equities. And that has a lot to do with the rules that the exchanges in options have to operate under, and the rules that the broker-dealers that control the customer orders have to operate under. And that is, in the options market, there are no dark pools. There is no opportunity to trade off exchange. As Congresswoman Maloney, you asked, where did it all go? Why is so much of it being done off the exchange? In the options world, by rule, it's not allowed. The SEC has come up with a good balance that says we understand that the broker-dealers want to interact with their customer orders, that word internalization that you heard before. But there needs to be a balance between removing all of that order flow from the marketplace to interact with it and having it participate in the lit market. And I've thought a lot about how do I give you a sense of what does it mean when you hear numbers like 30, 35% of trading is done off exchange. The fact is that retail flow, the good order flow, has been taken off exchange. 100% of that flow is off the exchange. Now, what does that mean? And I thought, in your language, the best way to describe it is with regard to redistricting, where you have an opportunity to try to figure out how to change the district lines so that you have more Democrats or more Republicans in your district. But could you imagine
Yeah, go ahead.
Please feel free, as opposed to the first panel, just to chime in.
So I wanted to add that I agree with what Gary said as far as what the important thing for Congress to focus on is. And retail customers really have never had a better experience in the U.S. equity markets by any traditional measure of quote spreads are down, commissions are down, execution speeds are up, and that's a very important thing to keep in mind as we undertake any sort of review of this market structure. The competitive markets that have developed are challenging for everyone who competes in it. And the beneficiaries have been investors and retail investors most notably. There's the segmentation of order flow that is often criticized allows hundreds of millions of dollars in price improvement to be given to retail customers every year. And that's not something we should forget because there's a lot of complexity or competition. And I just think we need to keep in mind that although maybe there's diminishing, things are not improving as quickly as they once were, we don't want to lose many of the benefits that we have gained over the past 5 years as far as the quality of markets that we now enjoy. We shouldn't take that for granted.
Well, I think Mr. Leibowitz's response to that was that the benefits have been dissipated. So, but I get your point.
So Gary played it right into my hand. So we run one of the largest off-exchange retail venues. I would point out we've been doing it since the 70s, so I'm not sure if that statement that it's been systematically moving off exchange is exactly right. That's been
Your mic closer to you, by the way.
But look, this really does come down to one of those many decisions that you guys have to make around what is termed fair. You know, to use by way of analogy, if we think of a healthcare type of issue, do we allow someone to have experiences be differentiated based on how they're born, if they have a genetic defect, or if it's something like, do they smoke or not? We have a world in the equity side where there is segmentation, and through that, the retail and long-term investors do receive systematically better execution experiences because, as has been pointed out, they can be targeted and be underwritten at a tighter premium. Now, is that a fairer marketplace? I feel so. And I would like to just simply point out, as you know, Gary was making the point on the options side, where that alternative isn't present, and I run both businesses, there is a very statistically different experience that the retail gets in terms of its differentiated execution, equities to options. So, you know, I think that this, if you believe in the principle, then you get to the next level, which I think is really the heart of the question. Why can my for-profit business provide segregated execution and their for-profit models cannot? That's, I think, really the heart of the debate here. Do you do it, and where do you do it?
Sure. Yeah, I mean, I think this gets to a lot of the crux of some of the issues here. First, it's very easy to say retail has the best experience they've ever had. Got to be a little bit careful there because we're only talking about retail market orders. Because when we talk about retail limit orders, they're the ones actually sitting on exchanges, not interacting with retail market orders anymore. And in fact, the experience of executing on the exchange isn't quite as good. Spreads have not gone down since Reg NMS, particularly if you look by strata of liquidity in the stock. And the toxicity of what they're interacting with is slightly worse. Now, that doesn't necessarily mean it's a bad thing. I think we have to decide, as Tom pointed out, and he's right, is do we believe in the principle of segmentation, or are we trying to create a market of the greater good? And it's not all or nothing, right? I don't think anybody would say there should be no internalization, there should be no dark pool, there should be no differentiation. I think you have to decide, it's a matter of how much and under what rules. And, as Tom said, should that just be off exchange or should it be on exchange? The challenge of doing it on exchange is it leads to an even more complex market, right? Our RLP system that we introduced a year ago was designed to differentiate for retail flow, to attract it. Almost an experiment. One of the first times that an exchange has been allowed to differentiate based on the kind of customer. Now, the problem is it can never replace the negotiation Tom makes with broker A versus retail customer A versus B versus C. So it's certainly difficult to compete on a level playing field with that, but it's better. But all it's done is create a dark pool on top of the exchange. And I think we just have to decide, is that where we're going from a public policy standpoint, that we're just going to ring exchanges with more and more dark pools that now belong to exchanges versus the off-exchange world? So in many ways, we just have to make that decision as a public policy and then decide, are we raising the bar for some players or lowering the bar for others?
From an asset management perspective, we value the choice, innovation, and competition that alternative trading venues offer to traditional markets. In our world, it's simply about best prices for our shareholders. It's less about ring fencing venues, as opposed to we create networks and we treat every venue across the same statistical framework. So whatever venue has the most market share, whichever venue has the highest quality flow, naturally gains more market share. But it's about building a network across every venue, both traditional and lit.
Make maybe one point about Reg NMS. Reg NMS was undertaken to address a very specific issue. So it was born of the best of intentions to try to address something that was inefficient in the marketplace. That was the fact you had certain, what we'll call traditional exchanges, who operated the floor-based model, and you had a collection of new exchanges which had an electronic model. The user experience of those were much different. In an electronic exchange, what you see is what you get. There's a displayed price. It's available to everyone. What you see is what you get. On the floor-based market, it was still a private price discovery pool available only to human beings who happen to own a seat and be physically present. The time horizons that these two models used to perform their price discovery were radically different. And what became apparent was that allowing the two to operate at the same time didn't work. What Reg NMS did was essentially force the human-driven markets of New York Stock Exchange and AMX to become electronic markets. They did that by saying, if you want your price to be respected within Reg NMS, if you want price protection for the limit orders that Larry spoke about, you had to make that, quote, electronically accessible. Once that was uttered by the SEC, the world changed overnight. The New York Stock Exchange, after 200 years, changed from a floor-driven market to now being an electronic order book. Once that happened, you now had all of the markets operating within roughly the same model. This should have made the interaction between the exchanges much simpler and much more straightforward and less confusing for investors. Unfortunately, Reg NMS also put a quite complex overlay of how the exchanges now had to operate with themselves. They said, well, this electronic price over here on this exchange has to respect this electronic price over here on that exchange. And it was almost like we took all of the exchanges were mountain climbers, climbing up a mountain. We tied them all together with a rope and then waited to see if one fell off a crevice and dragged everyone else with them. Once you have electronically accessible prices, everyone you see around this table and indeed in this room is eminently capable of differentiating between two electronically accessible prices. Having an order-by-order regulatory construct on top to enforce it is not necessary and adds a lot of needless complexity.
Gary?
Just wanted to jump in real quick. When I look at Reg NMS, one of the questions they didn't answer was, when is an equity market, when is it okay to be an over-the-counter market, and when is it okay to be an exchange market? Because they are two very different things. The NASDAQ stock market was not an exchange until after Reg NMS. It was born out of the OTC model. Same thing happened with ATSs. It was born out of the OTC model. And so the question really is when is it okay for something to be over the counter and when is it supposed to be an exchange? Now, when I look at the world right now, I look at Reg NMS and the access rule, which capped fees at 30 mils. Since 2005, commission rates for institutions have done a nosedive from anywhere from 3 to 2 cents in 2005 to under a penny right now. But at the same time, the exchanges have had them tight at 29, 30 mils on the take side. So the reality is one of the reasons why OTC or ATSs became very popular, as Professor Angel said, was because it was a way of managing costs. It was impossible for routing of orders to go to an exchange because the rates were too high. And so you can internalize at a much lower level. Now, the question is if I'm an exchange, am I the first one who's going to blink and change access fees and change structures? You've had some experimentation with that. There are 5 exchanges which have inverted, which now pay more for give relief to the taker than the maker. There are about 5 of them, and every single one of them has less than 3% or just above 3% or below market share. Hasn't been very successful. The ones that do work are when the maker rate is higher than taker rate is higher than the maker rate. So no one has moved off of that because you're afraid of losing market share. So one of the questions from Commissioner Gallagher is, does it make sense to lower the 30 mils? Help the exchanges so it makes it easier for them to compete, because the 30 mils, I look at it as a distortion in the marketplace, which is causing stuff to move more and more to move off exchange.
Yeah, sure.
Right. I mean, I think this gets to the crux of the issue, which is the main differences between off-exchange and on-exchange. I mean, people like to make the argument about anonymity, but aside from places like LiquidNet that have a relatively large average trade size, the average trade size in a dark pool is the same or less than on an exchange. So the anonymity argument doesn't really work. It's really about customer segmentation and access fees. That's really what drives most routing decisions. The problem for exchanges is you can't create liquidity on your own, so you have to incent it with a rebate. That drives the access fee. And so we're all sort of squinched up at the top of high rebate, high access fee. If we lowered that, we wouldn't be able to attract liquidity. So what we need, the challenge is lowering the access fee, which is clearly a much higher percentage of spread and commission at this point, right? Charging a point 30 cents 100 on stocks that are spreading a penny, it's a large price. So when we talk about even the high caps being efficient, I would tend to differ to say that with an access fee as high as it is, that's not really that efficient. And lowering that access fee in exchange for something that forced more volume to respect the public quote, I think would be exactly an appropriate trade-off.
I'm not sure that you have to force at the same time. I think you have to cut to see whether or not it actually has that entire and desired effect of moving it. Because once you start putting in things like trade at, you add in a whole level of complexity. And we've already talked about the fact that the market's too complex right now. And so an arbitrary thing of lowering price and seeing what the actual effect is may actually solve the problem rather than putting a whole layer of complexity on first.
My own view is that even having that access fee would not be nearly enough versus the average profitability, if you look at what market makers make and what internalizers make, that you would need to couple it with something on a pilot basis, or you would have even less liquidity on exchange. That's just from talking to internalizers, talking to market makers on exchange. That's just how it feels. To me, this is not about raising more economics to the exchange. To me, if we did not make $1 more in revenues and we could get better quality onto the exchange, that would be a much better situation. And that's where I think if you put those two together, you would get to.
You mentioned a pilot basis, that going in with a pilot basis. The SEC is looking at this holistic review of everything that I think is very difficult to accomplish. If you could propose a pilot basis that would help us understand or help you have a fair, better markets, what would that pilot basis be that we could request the SEC to do when you mentioned pilot basis?
Sure. So specifically, first one is the SEC is already looking at a pilot project for larger tick increments. And I think let's take that one aside. That's been studied by hearings and CorpFin at SEC, et cetera. I think having the access fee and combining that with a modified trade at, which said you've got to at least respect the inside quote unless you're at size or minimum price improvement. 70% of what trades in the dark right now is within 10% of the inside spread. So it's within 1/10 of a cent or 2/10 of a cent of the inside spread. That's not added value. If you had to improve either on size or price or respect that and then have a large decrease in the access fee cap.
I'm going to surprise everyone by agreeing with Larry, actually. No, I actually, no, I actually do think that that a trade-out rule could work if combined with a large decrease in the fee. With a fee of 30 mils, it simply doesn't work because all bids are not the same. And so a bid on an ATS that is free for us to hit is not the same as a bid on an exchange that costs 30 mils. Now, if you brought the maximum access fee down to a de minimis amount, say 2 mils or something like that, somewhere in the low single digits, then they start looking the same, and then a system like that could work. But there is one other caveat we think is necessary, which is there was something, Reg NMS mandated that there be something called the ADF, the Alternate Display Facility. And the Alternate Display Facility is operated by FINRA, and it allows ATSs to post bids and offers directly onto the national quote. Now, the ADF is not operational anymore. FINRA stopped running it about 2 years ago. Without the ADF up and running, a trade at rule basically says that an ATS has to post their bid or offer through an exchange. So it's basically a mandate that ATSs would have to pay an exchange to just put a bid or an offer out there. If the ADF was back up and running the way it was mandated that it be operating in when Reg NMS was passed, and the access fee be brought down to a de minimis level, then I think that then I think you could have a trade at rule, and it could potentially operate well.
Just to jump in there, I'm less surprised than the rest of the room to hear Larry and Dan agree on this, because what you're getting to is what Mr. Matchett said, which is you're getting down to the segmentation of order flow. Retail orders as a group are better to trade against than professional orders. The result of that is that because we allow segmentation of order flow through internalization in this market, the retail orders are vigorously competed for, and as a result get better fills than that in the regular market. Now, the New York Stock Exchange would be better off if all retail orders were forced onto the sunshine market, because the average toxicity of their order flow would be better, and the overall quality for the average order interacting with the market would be better. Credit Suisse would be better off having access to those retail orders directly instead of having them go first to a different internalizer. This gets to just a simple public policy choice. Do we want to have, as we do in the futures market, one order book where all orders are treated exactly the same, which works great in the futures market and is a valid choice? Or do we want to continue to allow retail order flows to be segmented and given better fills than in the marketplace? And there is, I think that's an interesting area for study, and to Congressman Maloney, it's perhaps something worth considering. But it is important to make sure that we do clearly distill that down as the actual choice we're discussing.
And so part of that also is, what is the benefit that currently exists that would potentially be taken away to the retail order flow, right?
If the retail order is treated the same as a professional order from Headlands, if you're competing to be on the other side of those two orders, you have to take into account the odds that you're going to be trading against me with the odds you're going to be trading against Jim from the first panel. And then you have to then sort of average out that, and you're going to make a slightly less aggressive bid for that order.
So why is that better for me if I stand in the position of the retail?
I struggle to rationalize that.
It's not, right?
Well, I think it is better for you because there are liquidity providers that want to be in that lit market and provide a continuous quote so that you always have a market to trade with. And when you take away those retail orders, when you're left with what we call in the industry the exhaust, it is difficult to get liquidity providers to make continuous markets in that lit exchange. And that's what will take us further away from a fragile lit market to a more robust market. I would also add that the pilot exists. It's not the futures exchange, and it's not the equities exchange, which are at the ends of the spectrum. It's the options exchanges, which do differentiate between customers, professionals, and liquidity providers, and force all of them to participate in a lit market. There is no dark pool, yet there is some form of internalization. There's a balance. And it says to a firm that if you bring that retail flow to the exchange, you can have a piece of it, but you can't have all of it. And by doing that, we have been able to attract market makers and liquidity providers, the ones that Larry is forced to pay to provide a quote. We can attract them to the options exchanges because the retail flow is still there. So you get that balance in an exchange. And it allows the firms to benefit from the flow that they are able to bring in through their network and through their system. But it also creates a system where there are two-sided markets at all times. They don't disappear. And in the flash crash, the options market quotes did not disappear.
Yeah, and I'm not sure that it's even as much as the quotes disappear. What you see is quotes widening on public markets, and the retail orders executing off exchange are priced based on the public market. So by driving the flow there, you could expect that you'd get tighter markets from the market makers. Second of all, you're currently disadvantaging retail limit orders, which are a reasonable percentage of the orders, but also don't forget that institutional orders are really retail customers investing in mutual funds and pension funds, that those institutional orders are not interacting with vanilla retail orders as well. So there's that other secondary effect of how retail customers would be advantaged by pushing things more towards the sunshine.
Could you comment on the changes for exchanges? That we now have roughly, 13 exchanges? Is that good? Is that bad? We used to have, 2 exchanges? Now we've moved to 13 or 3 exchanges. We used to have very few. And can you just comment on the exchanges and how this new process is working? Is it working well? Is it needed?
Sure. I think 2 is a better number. I think it would be hard to argue that 13 is the right number, but just like many other topics we're going to talk about, you can't regulate the number of exchanges very easily. What you can do is create the climate of competition that creates a better number. So for example, if you look, a good chunk of the exchanges that exist because of this low rebate world. If you push the access fee down, my prediction is you would end up with fewer exchanges anyway. We talk about this concept of exchanges being for profit driving this issue, and the reality is I think that's a bit of a misnomer. While exchanges are only newly for profit, it's not like they were charitable organizations before. They were being run for their members before, who were the banks and the brokers. What happened when the world changed and exchanges became for profit is that the interests of the banks and the brokers and the exchanges diverged. And so what ended up happening was you ended up with different pockets of investing, different market model structures, et cetera, and that's led to this proliferation of exchanges. Gary, you just got one more options exchange, the Miami Options Exchange, because we needed more options exchanges. But there's no natural force that will make that go away other than looking at what are the costs of being an exchange, what are the costs of the infrastructure, and it costs everyone in the system when we add another exchange because they need more connectivity. They need to add extra costs that everybody pays.
I'd just like to say a couple things on that. The first one is that exchanges make it off the spread. That's where they make their money, because for every buyer, there's a seller. For every maker, there's a taker. So the actual level of where the access fee isn't where the exchange makes its money. For the lesser-known exchanges or the lesser volume exchanges, the problem that we have is that there's a distortion in the market data side, in that the cost of the market data and the revenue that is received for producing that market data is grossly out of whack. And we just had actually a court decision a couple days ago called Net Coalition 2, where the second highest court in the land actually agreed that there must be an accounting of what the cost of the market data is for what is charged investors, and that is not being done right now. And we need to take a look at it because that's one of the reasons why we do have so many exchanges, because of the market data fees is what keeps them alive.
In the year 2000, when ISE was created, there were 4 options exchanges. They did not compete with each other. Their fees were high. There was no transparency. You could not see the size of the quote. ISE changed the entire landscape for the trading of options in this country. And that's because new exchanges were allowed to compete. And new exchanges bring innovation, and new exchanges bring competitive spirit, and ultimately, I think, give the customer a better experience. Now, if an exchange is too small and they can't exist and provide value added, then the firms shouldn't connect to those exchanges. But if an exchange can create new functionality and bring value to the customer, why would we want to regulate that away?
So I think Gary makes a good point, as does Mr. Stone. I mean, I think the whole topic of market data is an interesting one that needs to be looked at. I think there should be a de minimis rule by which small exchanges shouldn't get those benefits. And because it does allow de minimis players to hang on and cost the industry infrastructure. But on the other hand, it is really hard to argue that the New York Stock Exchange doesn't do a better job of servicing customers and providing technology than it did before competition. So competition is a good thing. It's a matter of, trying to find the balances.
I just think I'd respond to both Larry and Gary's points of view. So I actually do find I guess I would call it revised Trade Act that I've just heard Larry mention much more appealing. He has at least, recognized that it has to be economically equivalent if we're talking about trade acts. And then we can have a fair debate about whether a similar execution experience on both venues is appropriate. I like fair competition, but a trade act probably isn't the worst. If we're going to go in the direction, though, where that price improvement element is not meaningful enough, in other words, that we can go to that 10% that I saw in your proposal, then I think that it's perfectly fine. We would end up, just to be clear, with hardly any retail flow returning to the exchanges, because they do at present get systematically better than NBBO prices. So a trade at would not actually create any movement there, but it does at least create some view of parity around liquidity. So I want us to be intellectually honest about that. The second is, and I agree with...
Before you go there, so if it doesn't translate to a change in the flow, does that affect as far as the transparency?
There's two segments, and I think this is the heart of it. People are misinterpreting that the movement of flow off exchanges lately is retail. It's actually much more the longer-term institutional flows that are really trading through these ATS and dark pool networks. That's been the latest trend, is to segment that next tier of investing community. And that's really been the mobile point. And the point is fair. A lot of this stuff does trade at the same quoted price, but a very different economic price when you put fees into account. I do think that a trade at with, literally it's like a 10% price improvement is really more targeted at that particular business. It really doesn't go after mine, to be blunt.
To clarify, that wasn't my proposal. I mean, my proposal would be more meaningful price improvement. What I said was that's what currently trades. I would want tick increment or a penny price improvement, which you'll probably disagree with.
Then I would throw into the community
which is okay.
that if we go down that route, that would be a systematic transfer of very large numbers from retail investors and long-term investors into professionals and market makers. And we would definitely have to look at that as a cost benefit, but that's a wealth transfer proposal.
How can we improve investor confidence in our markets? Everyone writes about they're not going in, they're on the sidelines. I'd just like to hear how we could improve investor confidence.
I guess I'll let the retail guy go first. I think that 90% of what happened to investor confidence can go back to the flash crash. And I am a little different than other people. I have some strange views, but I've been doing this for so many years, and we have had technology problems galore. And what was so unique about the flash crash was that was the first time where the pain from that was borne by the investing community and was not borne by the major players in building that market structure. So if by way of analogy, everyone probably has a personal computer. It's probably crashed on you a few times. You've probably felt frustration, but it hasn't come and jolted you in the arm with a bolt full of electricity and affected your long-term future. That's what happened on that day. And I think the part that's interesting is we're trying to go at it in the mindset of we're finally going to succeed at building an infrastructure that can support all the extremes of fear and greed that humans can throw at it. And I think that's a little too lofty. I think the part that we have to address is why didn't we take the trades down? If we had taken that opportunity when it was right in front of us and pulled the trades off the tape, I think we'd be in a very different place than where we are today. And I think that's got to be a little bit more of our focus, is how do we actually prevent the pain from occurring, more than this market structure conversation.
Okay.
And
And microphone.
it ties back a little bit to what we were talking about before your question. Is I do not think that it would improve investor confidence if the direct investor, the individual retail investor, and retail investors also invest through mutual funds, as somebody made the point. But if they choose to invest at least a portion of their own money on their own, if they're the ones who are, their choices are reduced, and they see an increase in their costs, either through higher commissions or worse prices, however small that may be, I don't think that's going to improve their confidence in the market. I think when we look at this review, we need to be careful, as several people have said, not to say that retail investors have to be the ones that have fewer choices in order for this larger good of potential quality of prices. I think that trade-off is tenuous at best and very hard to evaluate. But if we're going to do it, we ought to be pretty sure it's going to work and be able to explain to investors how that benefits them, because they're going to very clearly see a reduction in very tangible reduction in the quality of their executions.
I feel that circuit breakers that have been introduced either at the market-wide level or the single stock level are positive. We'd also like to see more transparency, more operational transparency related to ATSs, so-called dark pools, in terms of how they operate, how they handle orders, either to the regulators, to the public, or to users and or subscribers.
I think people are touching on a lot of things. First of all, I don't think retail would notice, for the most part, this change as much. Doesn't mean we shouldn't consider it. That's not the issue of confidence. First, we have to remember that after the 29 crash, if you surveyed people, they had no confidence in the markets either. Right? We went through a very rough period in the market in terms of market performance. We shouldn't take that for granted. We added that to implementing a lot of technology in a very short period of time, in a lot of ways getting ahead of the regulation, right? Because competition always moves faster than regulation. That's just what it does, without all the right safeguards. So we are in the process of catching up, and I think limit up down is a good safeguard that helps us catch up. I think more transparency is good, except that when you watch the sausage being made, it doesn't always look so good. And I think we should watch that, because that is one of the things that's happened over the last few years, is the media covers every little failure on the exchanges and in dark pools and other places minute to minute. What we as an industry have to do a better job of is making sure those failures don't happen and to be out front about them when they do.
I think one of the things we have to do is we have to study whether or not people say that they're not confident and then what they actually do. If we look at the numbers, money has come out of the active management space. A lot of it, as Larry had said, is because of performance. But yet it's gone into ETFs, equity ETFs. So we've had a shift from passive, from active to passive. And at the same time, if you look at the DARTs, which are the measures that the retail brokers use, they've actually been going up since basically 09, at the near 10 or 09. So they've actually been coming back. And so I wonder how much of is the confidence, like I don't have confidence in the markets, but I'm still putting money there. And the other thing also is that this is a historic moment we've been at. We haven't been at zero interest rates ever for this prolonged period of time. And as an investor, I look at it, I'm like, wow, this is a dangerous place to be. And how much of that is actually what we're hearing from investors rather than the actual confidence in the way the markets and they work.
I would agree with that. When you look at investor confidence, it does seem like there was a dramatic shift at the beginning of January. Last year, there were only 4 weeks where there were mutual fund inflows out of the entire 52-week year. Now, since January, there's been 12 out of the first 16 weeks have had inflows. So money's been coming back into mutual funds. The indices are at all-time highs. People are talking about stocks again. I was in a cab and the guy was asking me if he should buy Tesla up here, off the news last week. But people are. It's.
Should he, or was that something?
I I believe it is a buy. Yes.
Okay.
No, but and on top of that, it's. On top of all that, we're seeing several measures that the markets are coming back. This morning, the Wall Street Journal ran an article you may have seen that the IPO market is the healthiest it's been since 2007. So these things do tend to be cyclical, and there are a lot of signs that things are roaring back this year.
In terms of confidence, probably what shook the markets more than anything was long-term capital. And I'd like to ask our panelists, what are we doing differently? It doesn't seem that we have any ability to predict systemic risk. We started to have an Office of Research to help put that together. At the last hearing, it was 3 years since they were created, and they're still just trying to find an LEI indicator. It seems to me to just get the broker ID would be better than trying to do this whole new level. And it doesn't seem that we have put in place anything that helps you or anybody else really see trends that may erupt or risk. I remember when long-term hit and AIG hit, no one could discern what was going on. No one knew the exposure. They came before Congress. We don't have a problem. The next day, we need 50 billion. The next day, we need 85 billion. The next day, we found another problem. We need 135. It ended up 185 billion that they never knew they were exposed to. So what do we have in place now that helps professionals determine exposure? And the private market is going to police themselves. They're going to be ahead of the innovation. They're going to know what's going on. And really, the SEC, with their holistic approach, I don't know when they're going to get to the specific problems you've been talking about. Anyway.
I'm so glad that you brought that up because, I grew up in North Carolina and my family is, I didn't grow up in a financially astute family. They didn't talk a lot about markets and so forth, so I often viewed as an interesting barometer to talk to them and try to explain what happened in 08, what happened in 98 with long term. And I always try to point out to them, when Bear Stearns was flagging, no one worried about what was happening to their equity book. No one worried about what was happening to their options book, and they were a huge player in both. They worried about what was happening to their mortgage book, which was an over-the-counter, non-centrally cleared set of products. AIG had 7 different mainframe systems that they kept their credit default swaps on and couldn't figure out how to even determine their own exposure. We have a tremendous advantage in this country with a central clearing model. We have Depository Trust Corp sits behind every stock trade in the U.S. So New York is free to compete with NASDAQ, and Credit Suisse is free to compete with UBS, because at the end of the day, you can buy on one and sell on the other and be net flat. That is an incredible reduction in complexity. Following that model, putting as many products after they come off the R&D assembly line in the over-the-counter markets and getting them onto exchange, getting them onto centrally cleared is great policy. What we have to do when they're on the public markets is remember the advantages of reduced complexity. Having this hub and spoke model where the clearinghouse is in the middle and the different exchanges can compete and sometimes die and leave the market and be replaced by new innovative players is a positive. But when we try to tie all of the end of the spokes away from the hub together on the outside of the rim, that's probably not helpful complexity. We want to stick to the advantages of centrality, central price discovery on these electronic markets. I think when we do that, the intuitive benefits of being able to know what the price is of Microsoft versus what the price of a resold mortgage on your house is worth are intuitive to any investor.
So is some of the suggestions here and the commonality that might be agreement on both sides here Is that an example of, as you describe it, of connecting on the outside spokes as opposed to, oh, I don't know, going back and going back to Reg MNFs and looking at to see whether we should recreate the
I
entity?
prefer a model where the mountain climbers are untethered.
Yeah.
And if there is a weak player, they're free to sit down and sit the rest of the climb out. And if they have equipment malfunctions, that the others can keep climbing. It is the creative destruction of American capitalism, and it's our greatest strength. And what I get nervous about is when we get into an order-by-order micromanagement of what has to happen to each order and has to tie each exchange together. I believe that on the flash crash, a lot of those problems were exacerbated by the fact that we did insist that every exchange had to respect every other exchange's price on an order-by-order basis.
Which goes back to M. Right.
Once on the flash crash, once one exchange had a system problem on that day, which meant their data was stale and wrong, every other market had to figure out how to then avoid that market. In every intermediary in the marketplace that handles retail flow or handles institutional flow is readily adept at avoiding bad prices. When the exchanges are forced to tie each other together, I think it's doing them a disservice and adding a lot of needless complexity onto the market.
And so if we tackle this problem by just I'll use the expression of a pilot program to try to address incrementally those things, then what's the result?
I'd like to see, well, I'd be interested in Larry's thoughts as an exchange model, but a group of securities where you had you untethered the exchanges and allowed them to be what they really are, which is a matcher of buyers and sellers, not an arbiter of buyers and sellers on their market and every other market. You don't ask American Airlines to check United's price before they book your ticket. You count on Expedia or Kayak or any of these other companies to do that yourself. I'm as an empiricist and a technologist, I prefer when there's greater division of labor and greater specialty of purpose.
I mean, the real question is whether your best execution obligation would essentially require you to obey everybody's type of book anyway. I mean, the reality is, I think that is effectively what needs to happen. The question is just what's the judgment that says this quote is a stale quote?
We all know the SEC is a very data-driven facility. You know, all of government is. They got to have the data, and I would like to hopefully join the chairman in saying if you have some models that you think the SEC should gather data on that makes some of the points that you are making today on how you think the system should run better, I certainly would entertain it. I'd like to study it. I'd like to submit it to the SEC. So I'd like to welcome that input from you.
On that subject, the SEC is better served with better data, and I think the consolidated audit trail is a great step in that direction. But one thing that has happened since Larry and I were back at Island and Ready running exchanges in the late 90s is that all around the world, around different geographies and different assets, you now have electronic price discovery. And one of the unintended consequences of that is now that what happens on the CME in gold trading and what happens on the London Metal Exchange in lead or aluminum trading affects what happens in the stock market. So if the SEC limits itself to only the data from the U.S. stock market, they're going to have a very hard time discerning what happened. And that is one of the lessons in the flash crash, was what happened when Chicago sneezed was that New York caught a cold.
And I guess some of us would disagree whether or not, although the SEC maybe has a lot of data, whether they're actually data-driven or not in their actions, but that's it. They should be. I was going to say, Commissioner, you want to?
I'm not touching that one. But before we lose the panel, I guess take it full circle again. It'd be interesting to maybe a poll or whatever your comments are. Should exchanges be SROs? I mean, has the model evolved so much since 1934 that it really doesn't bear any resemblance, and that the mixed bag of benefits and burdens doesn't make any sense? Is that something we should be looking hard at? Because of course, if we did, we'd be back here in front of Chairman Garrett and Ranking Member Maloney asking for legislative changes, because Section 6 is Section 6.
I'll jump in on that one. I think that it does not make sense to have for-profit exchanges be SROs. I mean, the system evolved in a very different way. And when the Exchange Act was passed back in the 30s, the exchanges were not for-profit entities. I mean, as Larry pointed out, they might not have been charities, but they weren't set up. They weren't set up to make a profit. And now they are publicly traded companies that are, for the most part, some of them are privately held, but they're all for-profit companies that don't look a whole lot different from the entities that they're regulating. And there's just an endless number of potential conflicts of interest when you have a regulator that's competing directly with other for-profit players.
Just go back, and this is just to reference the earlier panel. Markets, if you are operating a market, you have a choice to register as either an alternative trading system or as an exchange. And there's a package of benefits and burdens that go with each. An alternative trading system is not an SRO, but they also don't participate in the market data, revenue organizations, and they can't list securities. And those seem like big benefits that exchanges want. And I think that if you're going to reshuffle, take away the self-regulatory obligations, you also need to look at those other aspects.
Yeah, I mean, I think it's a really complex question. It's very easy to just sort of go, well, there shouldn't be SROs, because they're for profit. I mean, on one hand, the regulator is Chinese walled from the exchange. In fact, if we ever ask a question of the guy on the other side of the wall, we get a caution letter. But I think it is worthy of looking at it in the new world and saying, well, what does it really mean? And you can't pick and choose the things you take out of an SRO, meaning, well, you can't have market data, but your rulemaking capability has to stay the same. Right? It has to be looked at as a package of benefits and obligations, but also what purpose is it serving for the public? Someone has to enforce listing standards. Someone has to regulate the members of the market. It's a larger public market regulation question, and it's an appropriate one to ask. It'll be decided long after I'm retired from this business, though.
But those are two different, or there's a whole bunch of things. Those are two different things as far as the listing, which is done primarily internally, right, as far as those regulations. And then a lot of the other stuff, I don't know whether this is said here, is done outside, right? So FINRA steps into that place.
Yeah, at our expense, of course.
Sure. So you could probably break those down into those categories pretty neatly. And then you could get to your concern, I guess, Ms. King, that you could break them down and they would still have, you don't have the listing responsibilities, they would. So they would have that fee or cost for that. But for the other side, for the other expenses, that can be all external. It is right now.
My only point was it can be done, but you can't just look at the self-regulatory functions alone. You have to look at all the different functions the exchange does together.
Right. Right.
I think ultimately, if you were to start with a blank sheet of paper, you would never evolve a system where you have two competing sets of entities that essentially do the same thing functionally and then have totally different economics and legal regulatory frameworks.
Right.
So ultimately, I think you would want to get to something where it is a truly level playing field, where there's one type of market center with one set of rules and regulations and responsibilities and privileges, and the same economics, and then you would have a dramatically less complex system. But I also agree with Larry. We're a long way off, and maybe past the point where I retire too.
Well, that's the second roundtable when we get all these things. Other comments? Commissioner? Mr. If not, I think we're just about on schedule here. And I once again want to thank this panel for your participation, your input, your insight into these very important issues. And just like with the first panel, the discussion, the debate will continue. And I know we'll be probably seeing a lot of you both in our offices and down in Washington going forward. So thank you again.